We're going to have Osberg come up now and give some comments, or maybe a short interlude here while we make sure that the PowerPoint's up and going. And I appreciate people's patience and courtesy. As you know, this is a very hot topic, and that's why you're all here. So again, I appreciate people being polite and letting our speakers give their presentation. Want to go ahead and introduce yourself?
Yes. Hello. My name's Laura Etherton, the consumer advocate with Osberg. I'm also the director of Health Insurance Rate Watch, which is a project of the Osberg Foundation. Administrator Miller and other folks on the panel today, Suzanne and David, thank you very much for the opportunity to testify today. We really appreciate the opportunity to be able to analyze these rate increases now that they're fully public and available on the website, and appreciate you calling this public hearing so that the public can hear more about these issues so that they can be vetted in the full light of day, and so that the public can have a say in the process. So thank you very much for doing that. These issues are really critical. A little bit of background, just really quickly. Osberg Foundation is the research and policy sister organization to Osberg, Oregon State Public Interest Research Group. We're a nonprofit, nonpartisan consumer organization. And the Health Insurance Rate Watch project is a project of the foundation. It's funded in part, as you know, through a federal grant administered through DCBS. Through the project, our staff, our consulting actuary, and our advisory committee analyze pending rate filings and submit detailed comments to DCBS from a consumer perspective. We also work to educate and engage consumers and small businesses in the process, because both small business and individuals have rate filings that come before you, in which we analyze. I want to mention the folks who are involved in the advisory committee. I know at least one of whom is in the audience, maybe more. Jerry Cohen from AARP Oregon, Lori Sobel from Consumers Union, Jason McNichol from the Oregon Health Action Campaign, and also Jim Hauser, who's a owner of Hawthorne Auto Clinic, who especially takes a very close look at those small business rate increases. I'll jump into our comments now on the rate filing. In terms of a quick summary, after a very careful analysis of the filing, and after looking at additional information provided by Regence at the end of the day on May 31st, which we reviewed yesterday in response to questions that we had submitted to DCBS regarding the filing. So after a careful analysis of both of those, we are very concerned that Regence has not provided sufficient information to justify this rate increase. We are also concerned that a 22.1 average rate hike will likely drive more Regence customers to drop coverage or decrease coverage with benefit buy-downs, in other words, going into further higher deductible plans. We're worried that this may destabilize the pool and will likely actually result in further increases. I want to make about 4 points that lead us to this conclusion. The first, actually, before I do that, I just want to highlight and echo the comment about percentages meaning a lot. We earlier saw a Regence slide that said that of the premium increase, 14.8% was for care, 6.5% was for new benefits, and 0.8% was for administration. Just for clarity, I think it's important for the audience to know that of your premium dollar, it breaks down as follows in terms of what Regence is proposing for this increase. The premium dollar would break down into 79.2% for care, administration would be 19.7%, and profit, or the contribution to surplus, as Teresa Miller mentioned, is 1.1%. So just so we have all the percentages on the table. So in terms of the rate increase, Regence has increased rates by double digits every year since 2007. So as you can see on the slide, there was a decrease actually in 2006, and then increases 17, 14, 17, 24, 17 again, 16.4 last year, and then this year would be the proposed 22.1. During that same period, starting in 2007, you see a fairly significant decline in enrollment. And this really mirrors the rate increases. So when that decrease went in 2006, enrollment was going up, and those big increases came in, and enrollment dropped pretty significantly. And it's a little bit hard to see on the slide what the real numbers are, but what's happened is that Regence has lost about 43,000 members since that time, the height of 102,000 members, down to the rate that it's at today. We are concerned that Regence does not project any meaningful change in enrollment in the filing, even though they have seen these significant enrollment losses ever since they've been imposing double-digit rate increases. And without a credible explanation for why they expect enrollment to remain steady, we don't believe it's realistic to believe that this enrollment loss trend won't continue, especially given the size of this rate increase. We're concerned that the proposed rate hike poses a significant risk to the stability of Regence's rate risk pool, because as healthy enrollees see a big rate hike, they're going to make logical decisions. Are they going to go into a higher deductible plan and risk it? If they can't even afford that, will they actually drop coverage and take the big gamble and be uninsured? Will they, if they don't have a pre-existing condition, they may drop and try to get coverage with a different insurance company. But if you're sick, because this is the individual market, and insurers can deny you for having a pre-existing condition. If you're sick or have a pre-existing condition, you're pretty much stuck here. And so what that will result in is less healthy employees staying in the pool, and the healthier enrollees either dropping coverage or buying down into higher deductible plans. We, at Osberg Foundation, we requested additional information on these issues in mid-May and received a response on June 1st. And the response we received actually makes us even more concerned that Regence is failing to account for the impact that this rate increase will have on their enrollment and thus on their risk pool. Regence's response was somewhat misleading in terms of downplaying the magnitude of the enrollment decrease. In their response to us, they called our attention to the fact that even with the projected increase, the average rate increase since 2005 will be 10.8%, and of course that conceals the main point that the average rate increase has been 19.5 since 2007. And they also appeared to not be concerned so much about the decline in enrollment since 2007, comparing instead the 2005 number to the 2010 number, as though it had been quite steady, as opposed to peaking and then declining. Second, Regence, in their response to our question, claimed that they had no actuarial basis to project enrollment losses, but it was called to our attention by the actuary that we're working with that this seems to contradict actuarial standards of practice, which includes urging actuaries to consider the assumptions that are necessary for the filing, including enrollment projections. Again, we believe that their reluctance to face the severity of this issue troubling, and we recommend DCBS only approve a rate increase or rate change that ensures consumers are protected from instability in the risk pool in this market segment due to decreased enrollment and benefit buy-downs. Now, a related issue is what an insurer might do when faced with decreasing enrollment due to rising costs. And an insurer can adopt a number of different strategies to reverse such a trend. One option is to dip into its surplus in order to keep those premiums lower that would otherwise drive out the healthy employees, or the healthy enrollees. Now, given that Blue Cross Blue Shield, Regence Blue Cross Blue Shield's company-wide surplus is at 10 times the authorized control level risk-based capital requirement, so at 10 times the very minimum required. It would, reducing the growth of the surplus or even dipping into the surplus would not in any way threaten Regence's solvency. 10 times that risk-based capital number is at the high end, and Regence is financially on good footing. It's its risk pool in this market that is not so stable. However, Regence is not proposing to do this. Instead, they're proposing to do the opposite, which is to raise rates and devote 1.1% of the proposed rate increase to their surplus, or roughly $1.7 million. The second approach that an insurer might take when dealing with enrollment losses is for the insurer to encourage healthier people to actually buy down their benefits and get into higher deductible plans. And that seems more to be the approach here. Regence enrollees currently are clustered in the product with the least cost sharing, so the lowest deductible, and that will see the highest rate increase under this proposal. So specifically the people who right now have I would call it the richest benefit, although I don't think any of them could be described as rich at this point, they will actually see the highest rate increases. Now, while this approach can allow insurers to keep healthier enrollees in the pool, it can definitely lower the degree of risk sharing between the healthier and the less healthy people. So between, I believe it was, I can't remember if it was Kurt and Barbara, or, but between the sicker and the healthier people, which we want to see. And of course that has adverse effects on premiums over time. So taking these trends together, we're concerned that Regence is likely to experience a loss of enrollment and significant benefit buy-down, which will lead to further increases in administrative costs over an ever-decreasing number of people, spreading fixed costs over, and undermine the stability of the pool. I think just a note on this and how this can also relate with the efforts to reduce costs while improving quality and health. So reducing costs not by cutting care or focusing on higher deductibles, by making people healthier. A number of the strategies that Jared talked about are very real and very promising strategies that leaders around the country are investigating, whether it's the medical home or fixing how doctors are paid to focus on results, focusing on decreasing needless hospital admissions and unnecessary errors. All of those things are very real, and we need time for those all to work and to go after them as aggressively as we can. That combined with a reduction in surplus and actually investing in strategies that work to lower the underlying cost of care is more the direction that we'd be excited to see the market go. So those are sort of the big pictures around the enrollment and the impact of this rate on enrollment. I now want to turn to some of the actual numbers. One of the centerpieces of this rate increase proposal is Regence's prediction that medical trend will be at 12.6%. That is the exact same number that Regence has used in rate filings going back quite some years. And as you noted, Administrator Miller, that increase is actually a lot higher than what we're seeing other companies report in terms not only of their overall medical trend, and specifically we're seeing reductions in utilization, both because of the economy and because people have higher deductible plans, so they're not going in, but also because of a reduction in unit price, so in the actual rates. So a number of insurers are reporting both a reduction in the unit price and in the utilization. We're not seeing that being reflected in this number. Specifically to this number, this 12.6%, is about 6 times higher than Regence's actual claims experience, which was 2% over the almost, I think it's a 21-month period in this market segment. And according to the filing, the discrepancy is due to the fact that Regence relies on some models that it says correct for the impacts of demographics and enrollees purchasing lower benefit coverage. But in the filing, Regence fails to explain the details of that methodology or show the underlying data that supports that claim. And given the extraordinary gap between that 2% and the 12.6 that we end up with, we really do believe that Regence ought to provide that information to regulators and the public. When we asked for more information about the methodology and the data that went into that calculation on May 16th, when we asked that question of Regence and got the response just the other day, we noticed with some concern that Regence effectively refused to elaborate on that methodology or to provide details into that calculation. And again, this appears to be at odds with the actuarial standards. That actuarial standard of practice number 41, in the actuarial report, the actuary should state the actuarial findings and identify the methods, procedures, assumptions, and data used by the actuary with sufficient clarity that another actuary qualified in the same practice area could make an objective appraisal of the reasonableness of the actuary's work as presented in the actuarial report. And as we see in the filing, there is no data for us to begin to recreate any attempt to be able to do this. I'll just highlight this as I'm sure completely impossible to see in the back of the room, but the description in the filing is at the very bottom. This is what we're given in terms of methodology. Here's the 2% right at the bottom. I'm pointing at my computer. I have no idea why I'm doing that. Actually, right down there, 2% is, whoa, there we go, 2%, and then 10.6. How you get from 10.6 to 12.6, we also don't know. You can't just add them together. That wouldn't make sense. But that 2% number right at the bottom there, it explains this all to us by saying that claims are normalized for benefits and aging to determine the underlying trend. That is not a sufficient explanation of methodology, in our opinion. A couple of other things I just want to highlight for you. The medical trend also appears to contain what may be an inappropriate hidden profit margin in the form of a trend component labeled fluctuation. We asked this question in an earlier filing, actually in the small group market, and the explanation given was that this fluctuation factor was the standard deviation seen in the claims over the previous period. Of course, that the standard deviation is just how far off from the average the claims were in those periods. And so essentially the result is if Regence's predictions, quite conservative predictions, are true, that fluctuation factor will instead go directly into profit and then into surplus. So we would encourage the division to look carefully at that and make sure that that's not inappropriate. So I think just to sum up, we do not believe that Regence's filing justifies its selection of the 12.6 medical trend, and we urge DCBS to require Regence to more transparently lay out its methodology, calculations, and underlying data for developing its medical trend assumptions. And we also encourage DCBS to set out its own methodology very clearly for evaluating an insurer's medical trend assumptions as part of the review process. We've noticed as doing a number of different evaluations, insurers have very different ways of approaching this number. There's very little transparency or explanation of it more transparency and explanation would be, I think, helpful for everyone involved. Moving on to the next piece, the filing, one of the pieces in the rate filing that's required of insurance companies, and we really applaud this aspect that the division requires insurance companies to include this information, is they need to say what they're doing to help reduce costs while improving quality. And we know that that's really the key to this whole problem. We can fiddle around the edges of a lot of this, but the absolute essence of this is how do we reduce costs, again, not by cutting care, but by improving how we treat patients. How do we keep people their healthiest, either through immunizations and other prevention so they never even have the problem, whether it's through chronic disease management with diabetes and heart conditions so that people are staying their healthiest and out of the hospital. And a lot of the efforts around the medical home and paying providers differently are really geared toward getting those results that we want, and in some ways kind of getting out of the way so doctors and patients can really make those good decisions together based on very good information. So Regence does go into quite some length in the filing about their work in this issue, and does appear to be pushing a number of worthy initiatives to lower costs of healthcare, and this is very important. But in the filing, Regence provides really just paints a picture but doesn't give detail in terms of what specifically they're doing, how many doctors are being paid in X way versus Y method. And we're not seeing whether the savings, what the results are. So what are the initiatives to reduce costs? What are the results from those initiatives? And if those initiatives are saving money, are those savings being passed along to the consumer? Are they being reinvested in more aggressive efforts to further lower costs? What's the result? We requested additional information on these issues and received the response from Regence. And unfortunately, Regence writes that it is, and I'm quoting here, it is all but impossible to break out specific savings on an item-by-item basis. And then they reiterated much was already outlined in the filing. And we agree that it can be very difficult to design measurement for initiatives looking to save money. But there are a number of insurance companies and self-insured employers and folks like the Mayo Clinic and the Cleveland Clinic and folks right here in Oregon that are doing a lot of this very innovation and are actually having some impressive results, and we know that because they've been able to track the numbers. And so we believe that it is possible to track the numbers and see the results of the initiatives, and think that would be a very important piece to do. The next piece I want to focus on and wrap up, this is the fourth one, is actually the impacts on consumers of this rate increase. These are probably numbers that are frighteningly familiar to many of the people in the room. These are the kind of things we all look at when we're renewing our policies and looking at what we're actually maybe going to have to face in terms of our plans. So we looked at the three products that are actually available to consumers in this filing. The highest benefit is the one in the middle, actually, Evolve Plus 1000. It's the product with the highest enrollment, so most people want more insurance. It has a $1,000 deductible and a $4,000 co-insurance maximum. In other words, after you get up to that deductible and you pay that out, then you're on your own, paying either 20% or 50% of the actual cost of your care until you pay $4,000, and then you're done, and then the company picks up the rest. Again, of course, the number on the other side of the slash mark is if for a family. So for a family, it's 3 times that amount. I guess the fourth kid gets in free, or the second kid, depending. And drug coverage, similar in terms of copay, co-insurance, and the deductible. So those are the pieces there. And then, so even though this is comparatively richer than the other products, consumers will still pay significant out-of-pocket costs. In particular, patients on brand-name drugs are likely to hit that $500 drug-only deductible, and that will, of course, add to the costs enrollees can pay. So a very sick consumer could easily face $5,500 in out-of-pocket costs, in addition to premium and copays. The lowest benefit product we examined has, of course, even more significant cost sharing. That's Evolve Core 10,000, $10,000 deductible, $7,500 coinsurance. We've got some office visits, drug-only deductible there. And again, a very sick individual, you add that all together, sort of worst case scenario, they could find themselves paying $18,000 a year in addition to premium and copays. And finally, we looked at sort of the middle Goldilocks plan. This benefit has benefits identical to those of the $10,000, except with a $2,500 deductible. And here, a sick individual with this product could pay around $10,500. So what we did here is we really like to think about how this affects potential real people. So we calculated the premium rate based on the information in the filing to compare the resulting premiums, and also to compare that with the median income for Oregonians with individual two-person and family households. And we actually looked at whether the premium and the out-of-pocket costs would exceed 8% of the median monthly income. That number actually comes from the federal health reform. It's sort of the affordability index that is triggered in there. So it's the first time we'd really seen one of those, so we picked it. Lots of people will argue, I'm sure, that 8% is way too much, but there it is. So as you can see from this table, Sally, age 28, she has an individual plan, and we then evaluated in those three different categories. So you can see in the $10,000 deductible plan, that $18,000 altogether, and then we looked at the total potential monthly cost and broke that out and compared that. If you actually had to break that out by month, what are you looking at? So while $64 a month is actually, pretty darn affordable, what Sally's risking there is an $18,000 bill, and once we break that down over the month, it's pretty clearly out of the line there. And in fact, as soon as you get out of the $10,000 deductible range, well, and actually the $1,000 deductible range is clearly above the 8% in terms of the premium, and all of them are out of the park in terms of what someone might actually face if they had a pretty bad year. The second one we looked at was a couple, an older couple, Gladys and Eddie. I can almost picture them. They, again, what we're looking at here is in the $10,000 range, for example, the potential maximum out-of-pocket, and here we actually just doubled the number, so it's a deductible for each one of them and out-of-pocket max for each one of them. So $36,000 is what they're facing. The $10,000, that $1,000 deductible is still quite high as well. And then for the next one, folks can see is focusing on a family of some youngish parents and some youngish kids, looking also at what they're facing. And here, because they have 4 people, that out-of-pocket maximum goes up to triple what it would be for an individual, and we're seeing that at $53,000 in that $10,000 deductible range. And again, all of these are some pretty hefty sums for a consumer to be facing. And I think that it's clear to us that a 22% rate increase will make coverage even less affordable than it is today. It's clear it's not good for Oregonians' health or their family budgets. And the reality is that raising rates has consequences. It has consequences for Oregonians and our economy, and it has consequences for Regence in terms of enrollment and its own stability within this market. Healthier people will drop coverage or buy down coverage or go it alone, and this will make Regence's risk pool less stable and will further reduce enrollment. We urge DCBS not to approve this rate increase. It's not justified, and we worry it will only make matters worse. Thank you.
So, please. Thanks for all your work. We appreciate it.